Hi, Dan Kerr's DK Analytics. Thanks for tuning in. We just published a report on our site in the report section called The Widening Gap. October was a colorful month and our gap widened. That is how we perceive values in a world where economic fundamentals are heading south and equity prices are heading north, where solvency and liquidity risks are growing, yet bond prices are rising. So what's to make of all this? Well, as you've probably seen, we've recovered smartly from the summer crash, the stock market crash, driven by Greek bankruptcy, which was kicked down the road. Stock market candy has been put into place by the powers that be in form of more QE, more zero interest rate policies, moving to negative interest rate policies, and we're in essence sustaining a financial repression regime around the world, which has usurped the free market, private buyers and sellers, in terms of determining asset prices of stocks and bonds and other assets, and by extension, allocation decisions. So we don't have the free market working anymore, whether in pricing or in allocations. And this whole thing is continuing to come home to roost in a destructive geopolitical public policy stew, a toxic public policy stew, which we're doubling down on thanks to the ability to print money out of thin air. That's the glue that holds this regulatory insanity, this growing tax insanity, the politically driven energy situation, which we wrote about, this whole green cronyism. And also, it has enabled us to, in essence, continue to eviscerate, take away property rights of owners that risk their capital, that hire people, and at the same time, obviously, weaken the entire economy because the reason to produce and risk capital isn't there, so people aren't employed, and therefore people don't have the income with which to consume. We have seen in October many headlines of tremendous concern, whether it's the UK pension funds being underfunded each year to the tune of 5% of GDP, whether it's third world situation unraveling, whether it's emerging market nations where more than $3 trillion of debt has to be refinanced going forward, that the IMF, in essence, has downgraded to junk, meaning those entities, corporations or states, can't make good upon the obligations they have in either interest payments or principal, thanks to the rising dollar, also a key, and weakening commodity prices. We have a landscape in which Deutsche Bank, ridden with up to $70 trillion of counterparty risks or derivative risks, is terminating 35,000 people. We have a slew of pink slips likely in the offing in the United States on the back of discouraging Q3 results by S&P 500 companies. We have a stock market, Standard & Poor's 500, which has had 3 consecutive quarters of year-over-year negative EPS growth, despite all the financial engineering that's been going on. Yet the stock market is back to near all-time highs, and bond prices are, both bonds and stocks are priced for near perfection. And again, this is only thanks to the less than benign intervention by global central planners, aka central banks. So we not only see increasing issues with corporate titans and their plans, and Walmart in the United States showing us that the consumer doesn't have the wherewithal to continue to spend, despite the fact that Walmart is benefiting from a strong dollar. It's got the stagnant top line, shrinking bottom line. We have McDonald's threatening to go out of business. We have IBM, the poster child of corporate value destruction, with 380,000 people probably going to be issuing pink slips. We have Caterpillar, the pulse of global mining activity, that is firing 10% of its workforce. We have the Baltic Dry Index, which is trolling near all-time lows, indicating weakening global trade. and we have rapidly rising solvency and derivative risks. Just a moment on the derivative risks. I mean, we have incredible exposure by banks that at the end of the day, in essence, are making a largely off-balance sheet bet on interest rates staying low, erstwhile high commodity prices staying high, and currencies not deviating too strongly. But as we know, virtually all currencies have been in a bear market against the dollar. This has left banks, huge money center banks, including the leading 5 banks in the U.S., which have roughly $250 trillion worth of exposure to derivative contracts, where in essence they made a bet on sustaining the status quo, and it's not happening. It's unraveling. Commodity prices are heading south. Some key interest rates are heading north, and in the interim, currencies are all plummeting against the dollar, and we think that's the last man standing. But so we have this destructively weak global economic picture. We have pension funds around the world, not just in the UK, but in the United States. Chicago, in essence, declared bankruptcy. They're not going to be able to make their pension payments. Call it Detroit Revisited. There's tons of municipalities or states or smaller nations in a similar position, and we're not getting the private market engine started, much less running, because of our toxic public policy stew, as enabled by the printing press and artificially low interest rates. Thank you, central banks. So how can we, as investors, as Main Street people, or not the 1% cronies that get to benefit from the cream that rises to the top of all this madness, what can we do? Well, we can take our cue, I would argue, and this is what we go over in our latest report, the widening gap. We can take our cue from the central banks. We can sell what they're pushing up to levels which cannot be sustained. Stocks that have very high PEs before an earnings correction, before a recession where earnings typically crack 40-50%. Don't forget, we are in a position globally where we're not having productivity. We're just adding debt. We're adding solvency risks. We're adding counterparty / derivative risks. And we're killing the goose that lays the golden egg, the private market, upon which at the end of the day everything else rests, including the social safety nets. So if we want to step back, we take those overvalued stocks which have earnings depression ahead of them that could stay in the tank, that is the economy, thanks to where we've been and where we're going, for a protracted period, because we're not going to revisit sanity on tax or regulatory or property rights fronts, are we? Until we absolutely have to. So we could, at this point, say to ourselves, look, let's take high PE stocks, let's sell them. Let's take government bonds, which to me are overvalued junk bonds, meaning they have all the risks of default and don't protect against inflation, yet they're tethered to the printing press. So consider lightening up your portfolio, rejiggering it to include less high PE stocks, less of these overvalued bonds, also junk government bonds. Turn it into cash. And when you go cash, don't necessarily leave it all in your checking or savings account or in your money market, because all of those have either counterparty risks or they have potential bail-in risks, or you might suffer from cash being rendered a dinosaur or obsolete kind of risks, meaning you can't pull money out. Take cash, put it into treasuries, play the crony game, use the printing press, go short 1, 2, 3 month maturities, and then you have your cash surrogate. Or consider taking notes out of the system while you still can and putting them in a safe, and or consider purchasing real money, a real value preservation asset over time, namely physical gold and silver in the form of coins, again held outside of the banking system. I'll tell you what, in a relatively short period of time, whether it's 3 months, 6 months, a year, or might even be in 2 days, I don't know, and nobody does, we're going to have a major reset of stock prices and also bond prices. And when that happens, you can take blue chips like Nestle or 3M or other big companies that have been around, are going to stay around, have a moat, have a franchise, have stout free cash flows, can play the crony capitalist game well that we live in today. We don't have free markets, we have government markets. But those same stocks are going to get a haircut of a good 40–50%. And then by extension, the dividend is going to, you guessed it, double, all things staying as they are. If you can move out of overvalued stocks and bonds today, set aside the dry powder to repurchase these things when Mr. Market or when economics again trumps politics, or the business cycle just falls apart as it already is and can't be hidden anymore by our fudging statisticians and the governmental agencies which overstate GDP growth, real GDP growth, because they massively understate inflation. If we get to the point where stocks then follow the economy, don't forget, because of financial repression, the stock market is no longer a leading indicator, it's a lagging indicator. The stock market was the last market to know that everything was heading south in 07 and 08, right? So set aside assets, take profits in overvalued stocks and bonds, put them into cash, protect yourself against bail-in risk, go into some real money, silver and gold, and wait until you can buy blue chips with good yields at much lower prices or much higher yields, respectively. And as you wait, if you're fortunate enough to put enough of that, of those gains that you take, of the money that you take out of overvalued stock and bond markets into physical gold and currency, there's a chance that you might have a turbocharged asset, meaning real money, physical gold, physical silver, have been decimated by manipulations led by bullion banks, supported by central banks for a heck of a long time. So not only will you avoid the carnage if you go cash and go into real money, physical gold or silver, associated with the upcoming huge correction in the stock market. Don't forget, we're 7–8 years into an artificial recovery, long in the tooth and totally fake to boot. So when this whole thing falls apart, you're not going to be able to get out a day or two later. So it's better to be out a day early than a day late. And if you can purchase real money, then you have a chance of not only keeping your gains that you lock in by selling overpriced stocks and bonds, but that asset might become substantially more valuable. So you can kind of hit a double, if you will. You take your money out of the overvalued stock and bond markets, and you set it aside into cash, and you place it into real money, physical gold, physical silver, which could very well be much higher in 2–3 years as the manipulation of those assets, of naked futures selling, is overcome by physical market piercing the veil and determining the prices of gold and silver. And then you have the currency with which to possibly buy not only Nestle or 3M at half off, but you might have moved substantially higher in the value of your cash. That is, when you sell the precious metals and return to paper money, with which then to buy stocks that are going to be substantially cheaper than they are today. How's that for some ideas? I hope you take a look at our site. And the reports tab, the topmost report again is widening gaps. We go into this in more detail and counterparty risk situation as well. And we hope that you find this of interest. We look forward to feedback, and we say over and out for now.